BT slumped recently by 20%. Everybody would have thought BT was always one of those safe companies to invest in. Is there anything as a safe investment anymore, do you think?
Not really. Cash, is cash safe? You know, cash isn't even safe because in real terms it's been eroded. So, you know, everything has risk. It's about what level of risk you take on, you know.
I've got here, at any time we might be holding a company where accounting regularities come up. Can you comment on that?
Well, it's like we touched earlier, you know, it's a common thing where companies, you know, they report adjusted EBITDA and an EBITDA, which is an R on the end of it, and all, you know, all sorts of weird stuff. And it's difficult. I mean, I've got a couple of companies that are causing me problems like that. One of them reported today, Entertainment One, ETO, does Peppa Pig. And, you know, fantastic business. It's growing. I mean, its library has gone up from like $1 billion at the last results. It's now worth more than $1.5 billion, just the library, the content library. But the trouble is, when they report their figures, it's all adjusted EBITDA, and, you know, they have to make allowance for this, allowance for that, and you just think, well, what are the real numbers here? And when you look at the actual cash it generates, it doesn't generate that much cash. And that's a worry, you know, and that annoys me. But having said that, I still think, you know, it's good enough. The problem is they've been doing loads of acquisitions and stuff, and they've been putting a lot of money into the investing in content, and I think that's what's causing a lot of the difficulties with the accounts. But they've got a new accountant turned up, funnily enough, so I'm hoping he's going to make things a bit cleaner and sort that side out. But you've got to be careful. You know, the thing to look for is cash generation. You know, is the debt reducing? Is the cash pile increasing? That's really what tells you everything you need to know, really.
The hardest thing with share trading can be to ditch the shares that you love. So some people won't sell losers or shares they're in love with, and is this the road to losses?
Do you know, it's really difficult. I actually wrote a blog about this on my website, and I made a contentious view that actually falling in love with a stock is perhaps one of the best things you can do. If you've got a really good company and it's consistently growing and it's consistently delivering, selling is the worst thing you can do. And it's like I said before, it's like the biggest mistake I've always made is selling too early. So it really is a fine line, you know, and it's almost as if you really can sell too often. You know, you can trade too much. And I think it's you know, it's one of these things where you have a company you know really well, and you've had it for years and it's done really well, and it goes for a bit of a difficult patch or whatever, and you sell it because you don't want to be falling in love with it, whatever, and then you go and buy a share that you don't know at all, you know, and it's like, so you've taken money from something you knew really well, that you probably knew was just going for a temporary bad patch or whatever, or that you just thought was overvalued when in fact it probably wasn't, and you've put the money into something you don't know at all. It just, I don't know, I'm a bit uncomfortable with it, really.